Hi there and welcome to the channel. Just a quick one today about capital gains tax. So unfortunately there is a tax called capital gains tax, which usually works out at less than the income tax, and I'll tell you why. It's usually at a lower rate than income tax. In other words, income earned. In other words, if you're earning an income like from your job, or after you retire, your retirement income, your capital gains tax is less. And there's two reasons for this. First of all, there's a 40,000 Rand. This is now for South Africa, obviously. And this is also not financial advice. I don't take it that way, but just some financial education. So how it works is you get a 40,000 exclusion. So in other words, if you sell assets, certain assets are excluded and certain assets. So for example, if you sell, for example, shares, after you've held them for a couple of years, you sell your shares, you make a profit. Obviously, you've got your base cost, which is what you pay for your shares, and then you've got your cost that you sell at. You minus that. So let's say you buy shares for 50,000 Rand, and then you sell for 200,000 Rand. Then your base cost is 50,000, you sold for 200, so your profit would be 150,000 Rand. Now, if you sold it in the one tax year, then it would work out that you would take the 150, you would minus the 40, which is your annual exclusion per person. You would minus the 40, so that takes it down to 110, and then you pay tax at 40% of that 110. So and then you pay at your marginal tax rate. So you see how the rate is reduced from, for example, earning regular income. So it is a good benefit. Sorry, they actually increased now the capital gains tax limit, the exclusion from 40,000. So for this tax year now that we're in now, so last tax year it'll be, for example, that when you fill in your tax forms, it'll be 40,000. But now the tax year we're in now, which started 1st of March, is now 50,000. So that's how it would work. Then that's your primary exclusion. So, but what you can do now, obviously, tax it's illegal to do tax evasion, but you can do what you can do is you can reduce your taxes legally by, for example, let's say you sell, instead of selling 200,000 rands worth, you sell it over two different tax years. So in other words, you sell, for example, the end of February, you sell half, and then you wait until after the 1st of March to sell the other half. What you'll do then is obviously it'll work the same with your base cost. Obviously, if you sell half and half, then your base cost will be 25,000, and then you sell maybe, for example, 100,000. Then you can use your 40,000 primary exclusion in the one tax year, and then you can use your 40,000 in the next tax year. Like I said, perfectly legal, but it's just being smart about it when you've made a profit, to sell not in one lump sum or go. You spread it over two tax years, so that means you get your primary exclusion over the two different tax years. So you'll save a bit of tax if you do it that way. So that's one thing to keep in mind. There's another way. There's another way you can do away with capital gains tax, and that way is have a tax-free savings account. If you sell your tax-free savings account, you can make however much profit you make. Let's say if you buy 40 years ago and you make millions in profit when you sell, you pay your amount that you pay in capital gains tax is zero. So there we go. You've got obviously limits that you're only allowed to pay in. It's now 46,000 from the 1st of March, 46,000 per tax year. But your growth, your dividends, your interest, everything with that inside the tax-free savings account grows tax-free. And when you sell, you can sell at any time, but obviously it's better to leave it to grow tax-free and to take after retirement. When you take out tax-free in retirement, it's tax-free, no capital gains tax, no taxes on that at all. Okay, so there we go. There's a couple of ways that you can legally reduce your taxes. So wonderful. So follow me and like and subscribe to my channel, and I'll keep you informed on these things. Thank you.